Hello and welcome. In this lecture video, I will continue discussing the indirect method. So in the last lecture video, we started on the indirect method, and over here on your course pack page, I went ahead and wrote it out just because it's just kind of hard to, the print is a little bit small there, so I went ahead and wrote it out for you. So you got $38,000 net income. And so this is just following along in your course pack. The difference of that $20,000 accounts receivable is subtracted. And again, that's step one of looking at our indirect method, is looking at our changes to our non-cash current assets. So remember, accounts receivable was $40,000. Now it's $60,000, so that it changed, right? That increase is subtracted from net income. We look over here with merchandise inventory, $70,000. It increased to $84,000. The difference is $14,000. That increase is also subtracted. Remember, the rule is increase is subtracted. If it decreased, it would be added, but in this case, it increased, so it's subtracted. Then we look at prepaid expenses. It was $4,000 to beginning, $4,000 beginning, $6,000 ending. It increased by $2,000. An increase in the non-cash current asset is subtracted. So that's where we get this $2,000 subtraction. So remember, what we would do at the indirect method is we're going to go through, we're going to take our net income plus or minus all these adjustments to get down to our net cash provided. So we've talked about step one of the indirect method, which is our non-cash current assets. Now let's talk about our current liabilities, okay? So now let's talk about our current liabilities. And so when we talk about our adjustments to our current liabilities, we have a different rule. Okay, we have a different rule. The rule is actually flipped. We have an increase in current liabilities would be added to net income. A decrease in current liabilities are subtracted from net income. So this is the exact reverse rule of non-cash current assets. Okay, remember, with our current assets, an increase is subtracted, a decrease is added. With current liabilities, increase is added, a decrease is subtracted. Okay, so let's talk about why this rule works for our current liabilities. Why does this rule work for current liabilities? Well, first of all, we have to remember what current liabilities are. And I'm going to take a second to adjust the webcam here. Okay, so remember, current liabilities are those liabilities that we expect to pay within 1 year or the operating cycle, whichever is longer. Okay, so let's look at why this rule works. That an increase in the balance of current liabilities is added, a decrease in the balance of a current liability is subtracted. So let's go ahead and look at interest payable, okay? So we have interest payable T account. And interest payable is a liability. So I've got this $4,000 right over here beginning, and then $3,000 ending. So I'm going to put that on the credit side. Got that $4,000 beginning, $3,000 ending. Now, let's flash back to Accounting 101, where we think about the journal entry to accrue interest expense. So the journal entry to accrue interest expense is debit interest expense, credit interest payable. So if I want to find my debit to interest expense, I would find that right there on the income statement. So that means I got that $7,000 right over there. That means I've got this $7,000 right there, which is my credit to my interest payable. So in terms of my T accounts, I could put that right there. Okay, now take a second and let's think about, how do we solve for X? X is the debit, right? Because there has to be some debit, because you had a beginning, then you added 7,000, then you get an ending of 3,000. So what you could do is you could take the beginning plus how much was added minus the 3,000, And then that gives you this $8,000, which is your debit. Now, when would I debit an interest payable? When do I debit a payable? Think about accounts payable. When do we debit accounts payable? We pay it off, right? Remember, to pay off an accounts payable, the journal entry is debit accounts payable, credit to cash, okay? Or in the terms of interest, debit interest payable, credit to cash. So this corresponds to that credit to cash. So what does this $8,000 represent? How much cash you paid for interest. Okay? How much cash you paid for interest. So let's look at the difference in the balance, right? It decreased. So per the rule, this would be subtracted. This would be subtracted on our indirect method. And we can see that right over here. Our interest payable, give me a second. Our interest payable, okay, I'm going to pause the lecture video and adjust the webcam. Okay, our interest payable, it was $4,000, now it's $3,000, so it decreased. That decrease is subtracted, and we can see that right over here in our indirect method. Now, why is it subtracted? Because remember, what you're doing is you're taking net income, doing adjustments to get down to net cash. So if you think about net income of $38,000 is based upon $7,000 of interest expense. But as we saw a second ago, you actually paid $8,000. So you paid $1,000 more in interest than you recognize on the income statement. Why is that? Because you paid of some of last accounting period's interest payable. You paid off some of that in this accounting period. Okay, so what you have to do then, if you're taking net income, which is based on only $7,000 of interest expense, but you paid $8,000, you then have to subtract out an additional $1,000 to move from that $7,000 to $8,000. So that's why we subtract. Okay, so a decrease, so the rule becomes a decrease in the balance of a current liability is subtracted. An increase in the balance of a current liability is added. Okay, so the rule is reversed for current liabilities versus non-cash current assets. Okay, so when you're doing the indirect method, because I will give you a test question where I say do the indirect method for the operating activities section of the statement of cash flows, you don't have to do T accounts. You can, but you don't have to. I was just doing the T accounts to show you why the rule worked. What you have to remember is the rule. Okay, you have to remember the rules. And if you remember the rules, you can go through and do this, because all you have to do is look at the changes in the balances of accounts receivable, merchandise, inventory, supplies, other non-cash current assets, and look at changes in the balances of current liabilities. Okay, so that's step one. Non-cash current assets. Step two, looking at changes in the balances of current liabilities. Step three of the indirect method is to add back non-cash expenses, such as depreciation right over here. And where did I get that $24,000 from depreciation? Remember, I get depreciation from the income statement. Now, why do we add that back? It's because depreciation is a non-cash expense. So remember, the journal entry to record depreciation is debit depreciation, credit accumulated depreciation. There is no debit or credit to cash. No influence on cash. But you can see right over here, this $24,000 of depreciation is subtracted from sales to get down to net income. So net income, right, is going to be different from cash, partly because of depreciation. This depreciation expense is pulling down net income by $24,000. But if I want to get to cash, this is a non-cash expense, so I have to add it back. So step three of the indirect method is to add back non-cash expenses, and the main non-cash expense that we talk about in this class is depreciation. So if you want to think of it this way, add back depreciation. Okay, so step 3 is add back depreciation. Step 4 of the indirect method is to add back non-operating losses right over here and subtract out non-operating gains. Now, why do we do that? Well, we can see here's our operating gain. See? So it says other gains and losses, which means it's non-operating. Okay? Gain on retirement of notes, loss on the sale of plant assets. Those would be examples of non-operating gains and losses. We will add back this non-operating loss right over there, and then we will subtract out the non-operating gain. Why do we do that? It's because these non-operating gains and losses, think about what they're called, non-operating. And we want to get operating cash flows. So we want them out of there. Because we're taking net income, and this net income, these two numbers affect net income, right? And we're taking net income and adjusting net income to get to operating cash, right? We have to then subtract out any non-operating gains and add back any non-operating losses right there. Okay? All right. So then what we have is then we can add up. We can take our net income, and I believe this is actually 6,000. I'm trying to look at it on the income statement. Yep. 6,000, sorry. Put down $6,000 for that non-operating loss. We can take our net income, and then we can subtract and add all these adjustments. Add up the total of these adjustments. So we would take net income minus the 20,000, minus the 14, minus the 2, minus the 5, minus the 1, plus the 10,000, plus the 24,000, plus the 6, minus the 16, and then we would take all those calculations and either add it or subtract it from net income to get down to net cash from operating activities. Okay? So to recap with the indirect method, step 1, look at changes in the account balances of non-cash current assets. What do I mean by non-cash current assets? Those current assets that I expect to be turned into cash in 1 year of the operating cycle, whichever is longer. Examples include accounts receivable, merchandise inventory, prepaid expenses, and supplies. Okay? Then what we do is look at changes in non-cash current liabilities. What are current liabilities? Those current liabilities that I expect to pay within 1 year of the operating cycle, whichever is longer. Common examples of current liabilities include accounts payable, income tax payable, interest payable, wages payable, utilities payable. Those are common examples of current liabilities. So that's step 2. Step 3, add back depreciation. Step 4, add back non-operating losses and subtract out non-operating gains. The 5th step, add up all the adjustments, add or subtract it from net income, and then you have net cash. Okay? So in the next lecture video, we're going to walk through a whole problem doing the indirect method. Okay? All right, thanks so much.